little, like 2 minutes over, nothing too bad.
Yeah.
Okay. Let's get you started.
You guys will close the door.
Yeah, I'll close it. So, Chris Dalton?
Yeah.
Perfect.
Good morning. Good morning, everybody. Yeah. It's still morning? It's a good afternoon yet? No? Nova Leap Health. Cool. Good morning. Gonna get started now. Perfect. Now presenting Chris Dobbin with Nova Leap Health.
Thanks very much, everybody. Appreciate everybody attending in person or on the webcast. Recognize a couple of faces in here. So I tend to do a couple of things with these presentations. The first is to give a bit of an overview in terms of how we came about and what we've been up to. And the second is to try to give a little sense of what we're planning for the future. So it's with that in mind that I'll get started. So Nova Leap Health Corp is traded on the Venture Exchange, TSX-V, NLH, not to be confused with NHL for those that are following the hockey playoffs. I get that quite a bit. We're an in-home care company. And so what that means is that we're generally going into an individual's home, so normally a senior, and we're looking after them in their own home. So think about, mom or dad that has dementia, perhaps somebody that is towards the end of their life, they've had some sort of terminal illness, we'll look after them. Could be a spouse that lost a loved one and they want companionship. So that's often what we do, and I'd say about 75% of our clients live with some form of dementia. So there could be Alzheimer's, Lewy body, Parkinson's, like there's something that's causing a challenge to the family. And basically we're in there to provide support within the home. We also provide one-on-one care within facilities. So while the bulk of our work is within someone's house, we would also go into facilities. Could be independent living, assisted living, nursing homes, and we also provide one-on-one care there. So the scenario that we would get called in again is an adult child goes home at a certain time of the year, maybe it's like, Christmas time or something, and they realize, okay, something's a little off here with mom or dad, and maybe they need some assistance. And a lot of times these days, the adult children are sort of living away, and so they don't realize the challenges that have sort of, or the changes that have happened until they're actually home. And so usually they'll pick up the phone and call us, or they'll do a Google search, and that's how they get a hold of us. We would then send someone in that has a senior care background, could be an RN or an LPN, social worker perhaps, but somebody from our office would go and do an in-home assessment. So they would assess the situation, speak to the family members, understand what's going on, do a safety check around the house and so on, and that's how we would build a care plan. And then from that care plan, we would then assign a caregiver perhaps if it's a 3 or 4 hour shift, or a series of caregivers that are rotating through the home if it's 24/7 care. Okay, so we would do, could be as low as 1 hour shift all the way to 24/7. We handle it all. Okay, so that's generally how it works. We're in what's called the private pay space. So, in the U.S., you think about sort of Medicaid, Medicare reimbursement. That's not really the space that we play in. So we're private pay. So it's out of pocket to the seniors we provide the care to, or their adult children. Okay, that would be the bulk of how we're reimbursed. There is some veteran affairs work that we do, which is government funded, or it could be long-term care insurance, but we're primarily private pay, not Medicare or Medicaid space, okay? I've broken down here between non-medical and home health, just because those are two sort of distinct terms that are used. So the non-medical side, or home care, it often referred to is like, medication reminders, the dementia care, transportation errands, light housekeeping, meal prep, that's on a non-medical side. The home health side is typically under the direction of a nurse, LPN or an RN, maybe in concert with a physician, but that would be medication administration as an example. So those are two distinct differences. One is specifically on the medical side of things with administration of medicine, and the other side is non-medical, which is the bulk of our work. Okay. I'm not going to spend a lot of time on the home care industry. I'm going to say that I think everybody has a good understanding of the demographics. So There's an aging demographic, that started after World War II. We see that every day with an aging population. I think the stats I've seen in the U.S., there's 10,000 people turning the age of 65 every day. But basically for the next, 30, 40 years, we have an aging demographic before it starts to level off. So that's what we're in. There's also a movement more towards home care. If you look at the surveys that are done, 90 to 95% of the people that are surveyed would indicate they would prefer to stay in their home if they can. They can't always do it. Sometimes they may be better off in a facility depending on the circumstances, but the bulk of folks want to stay in their home. And if you look at, particularly Medicare, Medicaid, the cost of providing the service, it's a lower cost in the home than it is in a large facility where there's much larger overhead. So for some of you who've heard the movement to hospital in the home, that is a real movement. It's not obtained near the traction I thought it would at this point. That's not the space we're in, but I think there's a lot of energy moving towards the home, and that definitely is the space we're in. Again, primarily in the non-medical side, but to some extent on the medical side. So where are we? So I'm based up in Halifax, Nova Scotia, Canada. We have offices in Nova Scotia. I think we have 5 offices in Nova Scotia now. We've made a number of acquisitions over the years, which I'll take you through. I founded the business back in 2016, and we made our first acquisition in New Hampshire, I think at that time. We've since expanded to Rhode Island, Vermont, more in New Hampshire, Massachusetts. We have, I think, 5 offices now, Oklahoma, Arkansas, Texas, South Carolina, and recently Florida. So I'd say between, the end of 2017, probably until the end of 2021, we were averaging about 4 acquisitions a year. So 1 a quarter. Didn't always work out that way. At the end of 2021, we actually made 3 over a period of 2 weeks. But the average was generally about 1 per quarter. We were hit by COVID, which I'll take you through here in a bit. So we sort of paused the acquisitions and really worked internally on operations. Came out of that in pretty strong financial position, and then started going back to acquisitions. I'd say the mid last year, made another one in Massachusetts, made an acquisition mid-December in Florida, and then picked up a couple locations in Nova Scotia mid-January. So we're back on the acquisition front. So what do we look for? We look at Canada and the U.S. The furthest west we've gone to U.S. has been Texas. We're not going to go any further west than that right now. We do look in Canada, but again, all of our acquisitions and expansion have been in Nova Scotia thus far. But we'll make further expansion at some point, in Canada. These are small businesses, so the mom and pop. So within the home care industry, there are thousands of these mom and pop businesses. So mom and pop being, they were started by a single founder, perhaps a couple, right? They've been around for 10 or 15 years. That's generally what we're looking for. And they're probably doing just under $2 million of revenue. So really tiny businesses, but there are a lot of them. And so what we look to do is, cash flow positive and a good office. So what you get with a business is basically an office team that could be 3 or 4 people, and then caregivers that are out in the field, people's homes or facilities, which maybe they're 40 to 50 depending on the size of the acquisition. Okay, so that's typically what you get with an acquisition and the local brand and sort of the referral sources and so on that come along with that. So, we're really looking at the team within the office in particular to make sure that the team that we get is staying. All the acquisitions that we've made thus far, it's been more of a succession plan. So the founder's been there 10 or 15 years, and they're looking for an exit. Sometimes it's listed by a broker. Sometimes we reach out because we say, hey, we're looking to come into your market. Is there an opportunity to make an acquisition? So those are the ways that we get our deals. So direct outreach, brokers that know us because we've made so many acquisitions, some industry conferences I'll speak to. People come up to me after the conference, or assuming that the sellers had a good experience with us, they'll tell their network about it, and then we'll get some opportunities from that as well. So those are probably the 4 primary ways that we get acquisition opportunities. So we're really focused on 1 and 2 of the growth strategy, organic growth and acquisitions. A little bit less than joint venture partners. We're always keeping our eyes open and talk to people within the industry to see if there's opportunities for JVs, but we really haven't come across the right opportunity. So I'll focus on the first 2 a little bit. So here's our financial profile. So again, founded the business back in 2016. I think these are in US dollars, by the way. I think we had $40,000 in revenue in 2016. And we finished just over 25, almost 26 million last year US. So you could look, I think, at our business in sort of 3 phases. The initial phase from 2016 until basically the end of 2019, pre-COVID, where we were making a lot of acquisitions, significant growth, sort of go. We got hit by COVID for probably a period of 2 to 3 years that set us back, and we really focused more internally as opposed to going and making acquisitions, which is why when we came out, you'll see, I think, in the bottom right corner, the quarterly adjusted EBITDA. I think we have 7 quarters of very, very consistent cash flow. So, if you look at our financial statements from last year, we are profitable, we are cash flow positive. We've just started to take on some acquisition-related debt. We didn't have any debt towards the end of 2024 before we made our acquisition in Florida. We haven't done a financing, I don't think, for probably 3 years now. We don't need money. This is an awareness trip I make every year. We're not looking for capital. We don't need it. So we're a good, stable business. And if I don't remember, remind me at the end, because there's sort of a profile that I think fits us in terms of what we're looking for as a company from investors. Like there's a profile we think fits for us. That's a good investor profile. And I'm happy to share that with you if you're interested after. I think we're not for everybody. We're not for the quick flippers, the folks that are trading, and like it's a very difficult stock to trade. It's thinly traded, and as I go through, for those that don't know us, we over 40% is insider owned, right? So management is really aligned with shareholders. So there's a few key things I just think you have to be aware of before you'd ever consider making an investment in Nova Leap, and the primary one is you have to be thinking long term, because that's the way we view this business. We're steady, we're growing, we're stable. You'll start to see, because we've just made acquisitions, we should be approaching, certainly over the next couple quarters, $30 million of revenue, which will sort of take us to the next level. I think from an EBITDA perspective, we've just invested and are investing in a number of new resources in terms of people. So I think there's going to be some fluctuations in that. I don't think you're immediately going to see some uptick there. So again, we're sort of stable business right now. Again, cash flow positive, no need for capital. So I run a business out of Halifax, the CFO. We have someone that runs our operations here in the US, Melissa Anderson. And again, this is all available on our corporate deck's available on our website if you want to reflect it after. There's 6 of us on the board, 5 of whom are independent. So I have direct home care experience. We owned a home care agency privately for a decade. My wife and I did with a partner, Ann Whalen, who's the second one from the bottom. We actually just bought her business out of Florida in December. And so we got a couple of people on the board that have home care experience. The rest of them are either entrepreneurs or executives of publicly traded companies. Our cap table, about 87 million shares outstanding. Again, about you'll see insider ownership in the bottom left there, just under 42%. Share price has really not done much for, I'd say, 12 months. It's been pretty consistent over the last year. Fully diluted, 95 million. No one covering us right now. Usually those that have covered us in the past, we have had analyst coverage in the past, but because we haven't been raising money, they don't cover us anymore. Typically, the analyst leads into investment banking work, but we don't have any investment banking work to give. And that's it. So that's a little bit of a snapshot of our company. I saw a post on LinkedIn that I thought actually described us pretty well. It wasn't referring to us, but I'll see if I can pick it up and share it. With all the political stuff going back and forth. Sometimes it's hard to see business things on LinkedIn these days. But it was a post by Matt Sims, a guy I know well out on the East Coast. He's involved in strategy and execution and scaling. I've known him for probably better part of a decade. And he made this post, which again, I thought resonated well with our company. I prefer the camel way. The camel way emphasizes sustainable, profitable growth over rapid, unsustainable expansion, focusing on efficiency, resilience, and long-term viability rather than a growth at any cost mentality. It should work in the short term and in the long term. Build a model for tomorrow and today. And I actually thought that spoke pretty well about Nova Leap. Personally, I like the story of the tortoise and the hare. You know, I don't know if you guys know that one from years and years ago. Slow and steady wins the race, but I think that's been us. I mean, Nova Leap is an easy company to understand. We provide home care services to seniors. It's an easy market to understand. Everybody, I think, realizes that we're an aging demographic. We have pricing power because we have the ability to charge market prevailing rates, whereas you don't have the same pricing power Medicare or Medicaid. That's evident by the fact we've had increasing gross margins over the last few years. Pre-COVID, they were in around 33%. Post-COVID, they've been upwards of 38 to 39%. So again, demonstrating our pricing power. We've made 20 plus acquisitions. We're back in acquisition mode. You should continue to see an increase in revenue and a catch up in EBITDA once we've sort of internalized the last couple of acquisitions that we've made. There are thousands of opportunities in the coming years just because you have folks that have started their business over the last decade that have been looking to exit the home care space. So, you know, we love the tailwinds. We love where we operate. We know we're making a huge difference to the families we're providing service to. Again, profitable, cash flow, positive business that's easy to understand. And so we think we're in a very, very good position, a position from strength, and so that's the story of Nova Leap. I'm happy to take any questions you might have. Sure, go ahead. Yeah, so the question is around competition. Is it competition for deals, or is it competition actually at the service level of the local area? Yeah, so I would describe this industry as very competitive. There are actually a lot of providers within the local market. So if you look at the larger players, those would be usually private equity backed franchises. So Home Instead, which would be the largest global home care franchise in the world. They recently sold out. Brightstar recently did a deal with a PE firm. Comfort Keepers, Nurse Next Door, which is out of Vancouver, out of BC, Canada. The list goes on. I think there are a lot of franchises that are out there, and then you have these small mom and pop independents, non-franchise ones, which is what we're interested in. So it is a highly competitive industry. There's really not a lot of barriers to entry. In the investment community, you always talk about moats and stuff like that. I mean, our ability to scale and to hire, really, really good people, that's not something that somebody at the local level has the ability to do. If they're generating 1,000 hours a year and a week, and they're making, $1.2 million of revenue, and, you have your office team and so on, they're not making a lot of money. And so their ability to sort of work on the business is restricted, right? They're really in the business all the time. And so our scale provides a competitive advantage as we continue to grow. We can hire and attract good people. Sometimes those are sales personnel, sometimes they're experienced executives. We've hired both. And I can tell you the things that I was doing, in 2016 and 2017, from literally in a snowstorm, driving a caregiver to get to someone's, condo an hour away to make sure that person had service. I'm not doing that stuff now, right? I mean, we have, multiple locations across 2 countries, and the only way to be successful in that type of a setup is to have people that you trust and that are really, really good. And so I'd say every year as we've grown, we've added more experienced people, and the team that we have now is the strongest team we've ever had in our history. Yeah. 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 So the end of 2021, part of the reason that there was a blip there was because we'd made 3 acquisitions in December, and that carried on into 2022. But we did have a couple underperforming assets that we did say divest of. We closed down. They were smaller, but they weren't making money. So if I look back at the history of our company, most of the acquisitions we made have been cash flow positive. But there's one that we took on early on in 2017 that wasn't. And my view at the time was that it was just a math problem, meaning that based on the revenue they were doing, they had too many office staff. So actually, mathematically, it was impossible for them to make money. Their gross margin was great. It was about 40%. So we actually were making really, really good headway up until COVID hit. And then we couldn't get the headway we wanted. And given the impact it was having on our overall business, we decided to close it down. So we had a couple things like that at that point in time, and that's really the reason for the drop. It's just a loss of hours. So again, I'd have to go back to COVID, but a lot of it had to do with schools shutting down and the impact that had on that, and the availability of labor was very difficult at that period of time. So those are all things that have changed over the last couple of years that are much better than where they were a couple of years. But that's the reason for it. Yeah, go. Price per day? Price. Yeah, so we might bill $35 an hour, for example, and so someone could get an hour shift, or which might be higher at a different premium rate, like $40 or so, but it could be 24/7. So it just depends on the hours that someone needs. Utilization in terms of staff utilization. Yeah, so so I can tell you what our range is. We typically our target's between 90 to 110% of what they want. So a caregiver comes in and they will tell us the hours that they're willing to work, and that's how we know how to schedule them depending on their experience with the families. And sorry, what was your last question? What are we looking for an investor? Yeah, I know I got 2 minutes left, right? I got 1 minute, and you're going to tell me 1 minute? 3 minutes, all right. Okay, 6 things. Here's the ideal. This is my work on the plane on the way through here. So the ideal investor, I think, for Nova Leap, one is long-term oriented, right? That's how we think. I don't think about, people ask me, when are you going to exit? I don't think about exiting. I think about, how do I build a company, and how do I leave that so that my kids still benefit from this, in perpetuity. 2, you got to believe in the healthcare as a defensive growth sector, right? Obviously you have to understand healthcare and believe that, no matter sort of how the economy is doing and so on, that it'll continue to be a good industry to invest in. 3, appreciates roll-up and consolidation strategies. I think there's a lot of roll-ups that have failed, and I think a lot of people have had bad experience with roll-ups. We're not trying to be a bad experience as a roll-up, but there are some excellent ones out there. Constellation Software is one I'd hold up as being phenomenal, based out of Canada. Multi-billion-dollar company now. That was a roll-up. Started as a private equity-backed company. Values alignment with management. So again, we have almost 42% insider ownership. So, you have to sort of view that as a positive thing. I heard somebody make a comment one day at a previous conference saying that they thought over 40% was bad. And that was kind of shocking to me. I said, well, we put our money where our mouth is, right? almost 42% insider ownership. Obviously you have to be, look at MicroCap or NanoCap. And then the last I'd say is sort of patient but ambitious. When I talk about long term, it doesn't mean that you're not going to see returns for the long term. It means that we're building and we're making decisions that are long term oriented. Like if you call me next month and say, I didn't like your quarter, it's irrelevant to me. I don't care, because I'm not thinking about the next quarter. But I am thinking 5 years out. Right? I am thinking about the impact that AI is going to have on our business, and all the efficiencies that we could get, and the problems it can create, and how we utilize that. Right? I am thinking about the fact that with our aging demographic, we also have an aging caregiver base. What impact will that have on us a decade out? Right? Those are risk areas that we think about, or opportunities that we think about, that are irrelevant for the next quarter. So when we're making decisions, we're not looking to raise money. So I don't have to come here and sort of promote the stock and say, hey, we got to bump this up to do a discount for a financing. Like it doesn't matter. You know, we want people that we have investors that are CEOs now of publicly traded companies, or that have run corporate development arms of publicly traded companies, or that have been directors of publicly traded companies, have been successful entrepreneurs that have invested in publicly traded companies. And they've done that, and they've been investors for a decade plus in those companies. We love those investors. And I spend time talking to those investors because they can relate to what we're doing, and they can share their experience of how they did it, because their experience often mirrors what we're going through. So those are the type of investors. We have some funds that have been with us, you know, since really early days. So I love long-term oriented investors. Very difficult to find them. Like very difficult to find long-term, truly long-term oriented investors. But when we find them, like we find we get great value from them. So I got 30 seconds. 30 seconds. Yeah, last question. You know, the most expensive one that we've done, are you talking multiple or actually total dollars? You know, multiple, I think the most expensive one we did is 6 3/4, and the lowest one we've done has been under 3. So it's been, think 3 to 5, actually think 4 to 5. I'd say probably a little bit narrow. Think 4 to 5, that's what we look for. Yeah. Okay, all right, I got to wrap it up. I appreciate everybody coming out. Really, really appreciate your time and learning a little bit more about us, and enjoy the rest of the conference. Thank you.